According to Investopedia.com, the capitalization rate, also known as a cap rate, is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. This measure is computed based on the net income which the property is expected to generate and is calculated by dividing net operating income by property asset value and is expressed as a percentage. It is used to estimate the investor's potential return on their investment in the real estate market. While the cap rate can be used for quickly comparing the relative value of similar real estate investments in the market, it should not be used as the sole indicator of an investment strength because it does not take into account leverage, the time value of money, and future cash flows from property improvements, among other factors. There are no clear ranges for a good or bad cap rate, and they largely depend on the context of the property and the market. Assume that an investor has $1 million and he is considering investing in one of the two available investment options. One, he can invest in the government-issued treasury bonds that offer a nominal 3% interest and are considered the safest investments. And two, he can purchase a commercial building that has multiple tenants who are expected to pay regular rent. In the second case, as you see scenario one, assume that the total rent received per year is $90,000 and the investor needs to pay a total of $20,000 of various maintenance costs, property taxes, and et cetera. It leaves the net income from the property investment at $70,000. Assume that during the first year, the property value remains steady at the original buy price of $1 million. The capitalization rate will be computed as the net operating income divided by the property value. So in this case, in scenario one, 70,000 divided by 1 million equals a 7%. This return of 7% generated from the property investment fares better than the standard return of 3% available from the risk-free treasury bonds. The extra 4% represents the return for the risk taken by the investor by investing in the property market as against investing in the safest treasury bonds, which come with zero risk. Property investment is risky, and there can be several scenarios where the return is represented by the capitalization rate. Measure can vary widely. For instance, look at scenario two. A few of the tenants may move out and the rental income for the property may diminish to $40,000, reducing the $20,000 towards various maintenance costs and property taxes. And assuming the property value stays at $1 million, the capitalization rate comes to 20,000 divided by 1 million, or 2%. This value is less than the return available from risk-free bonds. In another scenario, scenario three, assume the rental income stays at the original $90,000, but the maintenance cost and or the property tax increases significantly, say to $50,000. The capitalization rate will then be 40,000 divided by the million, or 4%. In the final case, scenario four, if the current market value of the property itself diminishes, let's say to 800,000, with the rental income and the various costs remaining the same, the capitalization rate will increase to 70,000 divided by the 800,000, or 8.75%. In essence, varying levels of income that gets generated from the property, expenses related to the property, and the current market valuation of the property can significantly change the capitalization rate. The surplus return, which is theoretically available to property investors over and above the treasury bond investments, can be attributed to the associated risks that lead to the above mentioned scenarios. Risk factors include age, location, status of the property type, like multifamily, office, industrial, retail, or recreational, tenant solvency, and the regular receipts of rentals, term and structure of the tenant's leases, the overall market rate of the property, and the factors affecting its valuation, macroeconomic fundamentals of the region, as well as factors impacting tenants' businesses.